Now, within the market, so far I've only been looking at the technical charts or the relative strength, but I also wanted to take a look at the fundamental valuations. How are they placed in terms of valuation so that I get a complete picture and try to make sense of what's happening in the market. But note that none of this analysis that I do on the market is used for my uh, systematic quant strategies. They're independent. This is only for my knowledge. It might be useful, it might not be useful, but just as a learner, I would want to learn these things and share it with you. My strategies that I run, which is momentum or the factor strategies, have no bearing whatsoever of how the markets do and all. So let's take a look at the fundamental valuation metrics. So for that, what I've done was I've taken the Nifty 500 as a universe and I've seen its valuation metrics like uh, PE, price to book, and dividend yield. You can get this data from NAC. You can get all the historical indices. You can go to this website. The URL I'll share in the description. You can get it from 2001 onwards. In fact, I think you can get it even earlier also. But I at least pulled it from 1st November 2001. Now, once you have this data, what I've done was I've plotted the historical movement of Nifty 500's price to book ratio. So for that, I've used Python to plot this. Now, how to interpret this is you can see this black colored line is the price to book ratio, which spans from levels of 1.5 to 6.5. So this is the range within which the price to book ratio of Nifty 500 has traversed. Now, the zones that you see, the green color zone, light green, yellow, orange, and red, these are nothing but different zones that I've categorized based on the standard deviation from its historical mean. So instead of having a fixed value, like if anything is, let's say, less than 2 undervalued, greater than 5 overvalued, what I've done is I've taken the historical data and then found its mean and then placed plus or minus 1 sigma, plus or minus 2 sigma to get these valuation zones. Now, if you see the price to book ratio, it will give you some sense of where the markets are. Are they overheated? What is the valuation looking like? So, a couple of observations that I wanted to do. Maybe most of you might already know that the 2003 to 2008 was a phenomenal bull run. You can see the price to book ratio or the valuation multiplier zooming from 1.5x to 6.5x in the 5-year span. I think it is also accompanied by the earnings growth. So that was a double whammy where we see a phenomenal outsized returns in that decade. Now, post that, there was a slump, great financial crisis. It hit the rock bottom of 2, price to book ratio of 2 at the Nifty 500 index level. And from there on, it went sideways. The price to book ratio went sideways, but the Nifty 500 index did move because there was earnings growth. So when you multiply the earnings growth with a similar range bound valuation metric, you still end up seeing that the index has gone up decently well. And then comes the COVID crash. Again, we fell to the levels of 2, which was seen earlier during the global financial crisis. Now, this zone, what I believe is one part of the history. And post COVID, what we are seeing is a new zone where our range is not in the traditional zone of 2 to 3.75. From 2009 onwards till 2021, we were stuck in that zone of valuation multiples given to the Indian markets at 2 to 3.75. But after 2021 or COVID, I believe that our valuation multiple has increased. And the range, the newfound range that we can see is from 3.75 to 4.5. That's the new uh, valuation zone that India's markets are getting at. Now, with this new context, if you see where are we placed right now, we are close to 3.92, almost close to, not still there, but yeah, getting close to that valuation zone in the newfound region. This is my interpretation of this zone. I might be entirely wrong also. But yeah, this looks interesting. We have to see a couple of weeks, like where do we stabilize, where do we go from there. We can also see that during the early 2024 or the late 2023, we did go below this zone of 3.75 and we quickly bounced back. So that is the interpretation that I have, that the valuations are expensive, but if you see the newfound zone, we are almost at the coming to the bottom levels of the valuation zones. Now there's an interesting research paper uh, that is available, and even Marcellus also has done. The research paper was written by Mr. Rajan Raju. So there they take the historical cyclically adjusted P ratio and see the prediction of how far the markets go 1 year hence, given the CAPE. So I'll be talking about this research paper more in detail. But if someone is interested, please take a look at this link written by Marcellus on the Cape Fear. I'll tell at high level, motamoti, what is the takeaway from this. It's that they uh, regress the Nifty 50 returns with the cyclically adjusted P ratio and find that uh, the possible returns for Nifty 50 in the coming year might be in single to low single digits because of the elevated valuations. So this is a great way to set the expectations realistic of how can we, what can we expect given the valuations. So I'll be doing a detailed discussion anyhow in the couple of weeks. So that will be a good insight. So main takeaway from this is that yes, valuations are elevated, but it doesn't matter as long as you're following your strategy and having a longer term goal of maybe 3, 5, 7 years. Everything should pan out well. So that's the main takeaway.